All right. Hello, everyone. Welcome to class number 15. We have been, going a long way. We have learned, quite a few tricks last time with the MLO activities. Uh, Today we're gonna wrap it up. Actually, not wrap it up just yet. Just we got one more class for the MLO activities, and then we're gonna go into ethics. And once we're done with the ethics, we're gonna go with a couple, laws in California for the DFPI license in California. Okay. So, I should have changed this to 15. Okay, let's still have 14 now. Anyway, so now I'm gonna continue with the process of the of the loan, and when the borrower fill out the application, right? We collect the information, we collect the documents, we review the documents, and we update the application accordingly, right? And then we kind of verify, if the income is good, and then we check the credit, right? We check the credit, we check the DTI, and see if it's within the allowed range, and then we're gonna run the what they call is running the UAS or AUS. Okay, let me see what the AUS stands for. AUS is the automatic underwriter or underwriting system. Okay, so that step, when you access it, when you click it, it's gonna check all the information that you input, right, from the 1003, which is an application, and then it's going to give you an indication if this person is qualified or not. Okay, as well as if there's any additional information is required, right? So if you run that and the person is is qualified and get a pre-approved, and then from that point you can output the pre-approval letter. Okay, and then the buyer go out and find a home, and then the buyer get accepted for a home, right? And that is when we actually officially update any information that is required for the application. And usually that is when the application starts, because without the offer, an accepted offer, without the address, right, we don't have a complete application. Now we get the address, we got a contract, right? And then now we're gonna say, okay, we got 6 data points. So that is when we start the application, right? Reviewing the application, right? And then from that point, we got 3 days. Within 3 days, we have to send out the disclosures, as well as the loan estimate. And also within the 3 days, or the first day after the offer got accepted, the escrow company, which is hired by the seller, right, gonna open an escrow. Okay, that's open the transaction. Okay, and then so when the escrow officer open the file, the transaction, right, and we as an MLO gonna call the escrow officer and request for a rate sheet or a fee sheet. Okay, a fee sheet is that the sheet that say how much the escrow company charging for something, and what are the things that we can the borrower can shop, what are the things that the borrower cannot shop, right? And then we take that sheet back, we enter into that that application that that we start out with, right? We enter into all the fees, right, from the escrow side. And then we also, let's say if the borrower decide to lock on the rate, and from that point we got some additional information about the loan, right? The term, the rate, not entirely the APR, but some of the costs associated or fees associated with the loan. We enter that in, maybe the home doesn't need an appraisal, so we get a wait appraisal. Wait meaning that we don't have to do the appraisal. The lender doesn't need to send out an appraiser to appraise the home, right? Or if an appraisal is required, then when we mark the appraisal fee in it, maybe $650, right? We enter it in there, and let's say the rate that the borrower picked may have some credits, and then we put that credit into the LE. Or if that rate that the borrower takes may require some points payment of point fee, then we put that point fee in there, right? So after we've done all that, we collect all the information, we verify it, we say, okay, everything is all good, okay? And then, we submit into the underwriter. Underwriter gonna review it again and come back with any additional requests, require document, support or anything like that. Then the borrower, we work with the borrower to obtain those documents and then upload, or I send it to the underwriter. Okay. And then from that point, the underwriter review it again. If everything's good, we get an approved loan. If we get an approved loan, we get a CTC, which is we got a clear to close indication, right? When we get a clear to close indication, meaning that, on the real estate side, we can start removing all the contingencies, including appraisal, investigation, or inspection, and loan contingency. So when we remove all that, meaning that the buyer or the borrower is fully committed at this time. And if the borrower or the buyer decide to back out, then he or she may lose the earnest money deposit. Okay. So if everything's good, our contingency removed, the lender now gonna send out the what is it called, the closing department gonna generate the loan doc, right? Get the loan doc, escrow, schedule a notary, and the notary come out and then sign all the paperwork, all the loan application, loan document. Once that signed, it's returned back to the escrow company for a final check, right? Because the notary working with escrow company to get the document signed and then returned, the escrow company take that back. Sometimes they have to scan it and send it over to the lender, or sometimes they send the whole packet back to the lender. Okay, so that way, lender receive the document and then they decide, okay, everything looks good within 24 to 48 hours, right? Not including the weekend or holiday, right? And then on the day of for closing, right? The lender, actually the buyer's gonna wire in all the money into the escrow account. The escrow officer notifies everybody, including buyer, seller, agents, loan officer, loan processor, lender, right? Say, hey, we received the wire, the final close to, money, cash to close, right? All the required money in, and then notify the lender. The lender say, okay, if the money is in, we're gonna wire the fund to close, right? The money that the borrower, borrow to buy the home. And when the money wire into the escrow account, the escrow officer notify everyone that say, okay, money is in. Then title company gonna start, does his work by go ahead and go and record the title transfer at the county. And now, hopefully within a couple hours, the title agent come back and say, okay, we are successfully recorded. And when we get that indication or that notice from the title officer, and then the agent gonna go ahead and open the lockbox, get the key to the borrower, right? And then when that happened on the same day, the title company dispersed the big chunk of money from the escrow account to the lender. Okay, and as well as the escrow company gonna wire the money to the seller, and then that is called the disbursement process, right? And then commission sent out to most of the agents, right? and then eventually a copy of the title is sent to the home of the buyer, right? And that's almost like completely done with the transaction. And then the lender have a servicer contact the buyer and say, we're gonna, from this point on, we're gonna take we're gonna take your file and we're gonna process your file, and every month you pay us, okay? Or if there's an escrow account open for the payment, and then all the money go into that account, and then the servicer disperse that money, monthly to the lender, to whoever, the PMI, insurance if they pay monthly, not entirely for property tax, or when property tax time comes, and the servicer pay for that, and then the buyer just keep paying for that. So that's a whole process, okay? So when like I said, doing the reviewing the application, right? There's some processing and underwriting, review, are needed, so that to make sure that we get an approved loan. So for the borrower analysis, including what assets, right? The acceptable assets that may be used for the down payment, including cash, saving account, checking account, 401k, IRA, 7 banks, which is a 7 account, stock and bond, 7 bond, mutual fund, or any other investment account. Also, gift, gifts is allowed as well, right? A gift money. For the gift money, during the process, even before putting an offer, right? The loan officer is going to help the borrower to get a gift letter from whoever give the money to, and then include, and send that gift letter to the agent, the real estate agent. Real estate agent put in an offer, including the gift letter, the purchase contract, let's say what else? The pre-approval letter, bank statements showing the proof of funds, right? And then write an offer and send everything over to the listing agent. Okay, so and talking back about the gift, right? The gift only need to be wired in, like after the borrower signed the loan document. Could be right after that, or could be on the day of the closing, before 12 o'clock or before 2 o'clock. Usually before 12 o'clock is better. So give somebody some time, because sometimes if the wiring part take time, then it may delay the closing on that same day and may push to the next day. Okay, so that money, if it's possible, get that in as soon as possible. Okay, the borrower may have an asset by selling his previous home, so that he gets some money for the down payment for the next home, or the borrower is doing a refi cash out to get some money, so that can be given to can be used for a down payment for the next home. Okay, the types of classification of assets, cash must be able to verify, right? Whatever you do, you have to say you have $20,000 in cash. You need to be able to justify how you get that cash. Okay, you cannot say, hey, I just go out and I found it on the street. Okay, need to be justified. The money need to be legit. Okay, due to the fact that a couple act or law say no money laundering. Okay, saving and checking fund must be seasoned for 2 months. So this is important here, right? We haven't heard this before, but the money that the bank statement that that the borrower used for proof of funds, right? The money in that account, anything that more than 2 months, or more, can be used, as a season. Well, when we say season, is that meaning it's past 2 months. Okay, then that money is good. Sometimes that you have money that coming into the account, but it could be like the money from your paycheck, could be a money that you get paid, or for myself, right? If I'm doing real estate, right, I have a real estate transaction just complete. I got $30,000. I just deposit. That money is still legit, but I need to explain what that money is, and maybe I get a copy of the commission check that I got from the previous transaction, and then that money is usable, right? I don't have to be seasoned for 2 months, but most of the money need to be seasoned for 2 months. So let's say if the borrower have relatives, mom and dad, brother, sister that that want to give the money to the borrower to buy the home, they can put that money in his or her account, or the borrower account 2 months before the close of the transaction. I say before the close of the transaction because usually the transaction take about 30 days. So meaning that money probably gonna put in the 30 days before an offer that put in an offer get accepted. So that money can be seasoned, right? That is one way, is to legitimize the fund, or that that someone can buy a gift letter, and that money can also be used as well, right? But that money need to be stay in the the person that give the gift, right? So one of the most important thing when you help the borrower is that don't move your money around. If somebody give the gift, don't put in your bank account. Keep it in his or her account. And then you got a gift letter. And at the day of closing, just wire that money into the escrow account. Don't write a check and give it to you and you deposit it in, or don't wire into your account, because it's going to require a lot of verification, right? You don't want to do that, okay? As an MLO, you need to tell your borrower that so that he or she at the first day is aware of several things. First, don't move the money around. Leave it where it is. If you have a husband and wife, keep in the money separately, and then just wire that money in at the end. Okay. If your mom and dad have money give to you, or the money coming in from Vietnam, right? Put it in his or her account. Don't wire it over to the borrower's account. Okay, and write a gift letter, right? That way we have less thing to explain to the underwriter. The less thing that we're gonna explain to the underwriter, the faster and the probability of getting that loan approved higher. Otherwise, you're gonna have a heck of a time explaining. Okay. In order for the fund to be considered a gift, there must be no expected or implied repayment of the fund to the donor. Okay, if it's a gift, you don't expect to pay back, right? Proceed from a selling property can be used as a source of asset as well. Asset permissible to be used toward reserve funds. So some loan program, right? Some borrower may have really low credit score, not as good at credit history. DTI may be high, right? So some of the loan program require that a borrower need to have a reserve of 3 months, 6 months, 9 months, or 12 months, or sometimes even 24 months. Okay, and the fund that can be used of the reserve funds, including checking or saving account, trust account, stock or bond investment account, CD, or certificates of deposit. It's just an account that when you put in the money for, let's say 3 months, 6 months, you get some interest out of that. It's called a CD. The cash value of invested in life insurance policy. Okay, maybe somebody have a life insurance policy that can borrow the money from that account. Okay, money invested in the 401k, IRA, or any retirement accounts. So the required mortgage reversed by loan program. So now we okay, the required mortgage reserves by loan program, including conventional loan, right? Zero conventional loan may require like 6 months, 0 to 6 month reserve. Okay, depending on, like I said, the borrower credit, debt to income ratio, loan to value ratio. Loan to value is you borrow, let's say if the home cost is $1 million, you down 20%, then loan to value is 80%. Okay, you borrow 80%, of the total value of the property. Okay, so it's called loan to value. So FHA reserves are usually needed if you are financing 3 or 4 unit property with an FHA loan. However, it's best to inquire with your lender to know if they have different rules. Meanwhile, 1 to 2 unit housing does not require mortgage reserve. So remember that reserve fund doesn't require for FHA loan for residential property. That's 1 or 2 units. If it's 3 or 4 units, then yes, you need the reserve. But it's just for 1 or 2 units, then you don't, right? FHA usually that for primary resident only. Okay. So let's say if you have like a multi-unit, right? Could be a duplex, could be 3 units, could be 4 units. So the person can live in 1 unit and rent out the rest. Okay. VA loan. VA loans also typically do not require mortgage reserve unless you need financing for 3 or 4 property units using rental income to apply. Okay, same thing. Okay, VA and FHA have the same requirement. Okay, 1 or 2 unit, no reserve is required. USDA loan. USDA do not require reserves, no matter how large the property is. Okay, USDA loan is the only loan that doesn't require reserve. Okay, conventional, yes, 0 to 6 months or sometimes 0 to 6 months for conventional loan. But if it's a non-QM, maybe 6 to 12 to 24 months. Okay, liabilities. So we talked about this. Liabilities, debt, student loan, personal loan, and a whole bunch of them, right? Minimum credit card payments. Okay, so when you borrow the money or when you're using the credit card, right? Let's say you have a credit line of 10,000, you use 2,000 this month. Guess what? Next month you only need to pay $20. That is called a minimum payment, right? The minimum payment take into account of let's say if it's a 0%, then what do you pay back is mainly the the minimum payment. Usually the creditor want you to pay 2% of your entire balance. So if it's $1,000, you pay $20. Okay, you pay $20, and if it's a 0%, because some credit card allow you like a 1 year 0%, then that 2% that you pay back or $20 that you pay back actually go back into the principal. But if you have a credit card at 10%, then when you only pay the minimum, meaning that you don't even pay enough for the interest, because the interest is 10%, but you pay back $20. So meaning each month the bank charge you $100 interest, and you only pay back 2% as a minimum, right? Meaning that you owe additional 80% or $80 into the total balance. So if you use $1,000, 10%, you pay a minimum 2%, $20. You're gonna owe additional $80. Now your loan or your credit balance is gonna be $1,080, and then the next month it take 10% of that amount again. So if you don't pay off quick, then that money gonna keep growing, and you have to pay more and more interest. Okay. Okay. Let me see. Student loan, right? We talked about that. It's also a liability. Auto loan is also a liability. Home equity line of credit. Okay. Special case about home equity line of credit. People take out the HELOC or home equity line of credit because their home got some equity in it, right? Let's say if they bought this home $500,000 like 5 years ago. Now the home is $1 million. So, and throughout 5 years, right, they pay back some money, right? $500,000 originally. They may be paid back like, let's say $30,000. So they may still owe like $470,000, but that equity is $530,000. So now because of that, right, they're gonna take out equity loan, right? That equity loan is an open-ended loan until the borrower is using it. So when it's open-ended, meaning that, hey, you can take out a $100,000 line of credit. So it's a money that you can use it anytime, right? So it's an open-ended. So now let's say you use that money, go out and buy a massage chair, right? And that massage chair costs you $10,000. Okay, and now right, you have 100,000, you use 10,000, you still have 90,000 to use, and the HELOC, you only pay interest on the money that you use. Okay, so meaning that if that HELOC is 7% and you use $10,000, right, you may have to pay what $70. Okay, so that's also saying that you can also fix that portion that you just use. So meaning that you can fix that $10,000 into a 20 years payment. Each month you pay let's say $150. Okay, so it's just an example, right? So now that loan, that $10,000 loan, become a fixed loan, and that become a closed-end loan, and the rest of the 90,000 still an open-ended loan that you can still use, right? However, because you say, hey, I have 100,000, I only use 10,000, I don't, I haven't used the other 90,000, right? So my liability is only $10,000. No, it's not like that. When we do a mortgage, right, the liability or the payment that need to be paid into a HELOC, usually about 1%. So if you open a credit line of $100,000, right, then when we calculate the DTI, that means each month you're gonna pay into that HELOC $1,000. Okay, regardless how much you use. Regardless how much you use. You can use none, you can use $1, you can use $100, right? That means that there's a commitment of $1,000 payment or expense that you have to take into account when you calculate the DTI, right? So meaning if you have a HELOC of 100,000, you don't use anything or you use everything, it still count at 1%. So the DTI expected that every month you're going to pay $1,000 for that HELOC. Okay, if you have a $200,000 HELOC, every month you pay $2,000 for that HELOC, regardless you use it or not. Okay, so that also draw a really interesting point. That meaning having a HELOC is good, right? You can use that money anytime. You can use that money to go buy a house too. However, the disadvantage is that even if you don't use anything, that's a commitment payment that you need to to put in the DTI. If you have a $100,000, you pay $1,000. Maybe your income can offset that, right? But if your income cannot offset that, then your DTI is going to be extremely high, right? Even you don't use anything. So that's why when a borrower want to take out a HELOC, has to consider what is the future plan. Are you going to go out and buy something? Are you going to go out and buy a property? But make sure you have to take into account of this HELOC limitation, right? Instead of you open a HELOC for $300,000, just take enough. Maybe 150 is good enough. Don't max it out, because if you max it out and your income cannot cover that expense, and then your DTI are going to be way high, right? So advise your borrower on that scenario, right? HELOC is good, but sometimes it's bad if you decide to buy the next property, right? It's gonna drag down your DTI big time, or I should have say, it's gonna increase your DTI big time and drag down your ability to get the new loan. Okay. Alimony and child support, right? Those are liabilities. Okay, the type of liability including what? Credit card balances, installment loans, which is car loan, student loan, and boat loans. If you have a boat, you have a loan. Okay, alimony and child support. So those are the type of liability. So in the test, if someone say, hey, what are the liabilities? Okay, what are the type of liability? They give you a list of them. Credit card balance, installment loan, alimony and child support, or D, or of the above. If you pick one of the three, you're gonna get the wrong answer. You have to pick D, all of the above. So you need to be careful when you read the question. Okay, income, as well as the answer. Okay, so what I consider income? Income considered as a self-employed applicant, which is a 1099 or tax return. Okay, if you're 1099, you may get the payment, weekly, bi-weekly, monthly. Okay, but as a 1099, as a contractor, or you can, if your money is seasonal or have a variation, and then you use a tax return, which is to take everything as a whole year, as a whole number, and divide that by 12, you get the monthly income. When we calculate the DTI and stuff, right, we calculate per month. Okay, so meaning that if the income, if you get a paycheck, twice, okay, that's a difference. If you get the paycheck, bi-weekly or twice a month. Okay, anybody can say, is that the same or is that different? Bi-weekly or twice a month? Can somebody type in the chat and tell me if it's the same? Come on, give me some answer here. Is the biweekly income and the twice a month income the same? It should be different. Twice a month, meaning that 1 year you only get 24 payments. But bi-weekly, you have 26 months. That's like a 52, that's a 52 weeks a year. So if you get your bi-weekly, right, you may have 26 payments in total, right? So 26 payment bi-weekly, and then 24 24 payment for twice a month. That's like 2 weeks different. Okay, so meaning that twice a month, you get paid higher for each paycheck than the bi-weekly. But with the bi-weekly, there's 2 months that you get 3 paychecks. Okay, so that's the difference. Okay, so but anyway, if it's twice a month or if it's bi-weekly, for the twice a month, it's easy. You multiply the paycheck by 2, you get the monthly income. For bi-weekly, you have to multiply each paycheck by 26, right? You take that paycheck, you multiply by 26, you get the whole year. And then you get that number, you divide by 12, you get a monthly. So that is how you do a calculation, okay? Utilizing the capital gain income on an application. Capital gains, what is it? It's a profit from the sale of an asset, such as stock, business, land, work of art, okay, or a house. Capital gains are generally include in taxable income. Okay, you get the capital gain, you have to pay tax for it, but are taxed at a lower rate. Okay, capital gain usually taxed between 15 and 20%, depending on your tax bracket. Okay, for your youngster there, what's the tax bracket? Right, tax bracket is that if you make $100,000, you may pay 25% tax. If you make $300,000, you may pay 35% tax. So different level of income, you pay a different level of tax, and that's the tax bracket. Okay, income, some loan qualification, steady salary or irregular income. Okay, I should say income for loan qualification. So you can get the salary loan, or you get irregular income, seasonal income. You just have to average it out. Okay, social security and or disability income that may be applied toward the loan analysis or as a qualifying income. So some, senior, right, they can have social security check from the government. They may have a disability check from the government. They may have SSI check from the government, right? Those are eligible income that you can use. Okay, but there's some catch to this. Okay, some benefit for a particular type of income. Anyway, Social Security Disability Insurance is called SSDI, or Supplemental Security Insurance, SSI, can use to help qualify for home loan, right? Untaxed, but these are the untaxable income, meaning the government paying you this, but you don't have to pay tax on it. Okay, any untaxable income can be used as 115%. So let's say each month you get SSI, SSDI, a total of let's say $1,000 each month. That meaning that you can actually get $1,150 a month as the qualified income. Okay, even you only get paid 1,000, but the calculation take into account that you get a 115% of that money. If you get 10,000, imagine that, right? You may have 11,500 total of income monthly. Okay, so keep this in mind. Anything regarding Social Security or disability, right? The income can be counted as 115%. If you have a regular salary account and regular paycheck, it's only count as a 100%. Okay, documentation of work history and income where there has been a gap in employment. Okay, so now there's some time that people are taking a couple months off, no pay. Okay, so it's called a gap. Okay, if you work a year, 12 months, and you take 2 months off, go travel, right? So you get a gap in there. So if you have a gap in the past 2 years, lenders are more concerned by unemployment period of 6 months or more. So if you only take 2 months, between 2 years, within 2 years, or let's say 4 months between 2 years, that should be okay, right? They may have to average out your total income for the 2 years. Okay, they add everything up for 2 years and they divide that by 24 months to get a monthly income. However, it's going to be a concern for the lenders. If you take unemployment or you don't make money, you don't get paycheck for 6 months or more, right? And that's an issue. So if you were out of work for just a month or two, that may not be an issue, right? Meaning that, let's say if you get a laid off, right? And then next month you get a job, then it's not a big thing for the lender, right? Because you already get a job now. And especially if that job is within the same field, right? If you are computer science, you got a layoff from Amazon, next month you get a job, back from Microsoft, then that should be okay because this is in the same field. However, if you work at Microsoft, right, you get a laid off and you become an Uber driver, that's a totally different thing. Okay, so your income will recalculate starting all over. Okay, so meaning if you got a gig economy job, now you have to wait for 12 months or even 24 months before you can qualify to borrow the money. Okay, same field, same industry, you don't have any issue. But if you change industry, then yes, you need to accumulate over a year or two. Some program require a year, 12 months. Some program require 24 months. Income, okay? Calculating monthly income need to come up with the monthly gross income. So like I say, for any loan to calculate the DTI, it needs to be a gross monthly income, right? So let's take an example, right? If you have an hourly income, you need to average number of hours per week that you do. Okay, you multiply that hour rate for that weekly hour, right, by 52 weeks, and then divide that by 12 to find a monthly gross income. Oh, it's so confusing. Okay, but anyway, here's an example. Let's say if you make 8 hour, $20 an hour. If you work 40 hours a week, you multiply that 40 with $20, right? That you make $800 a week. And if that income is stable, not variation, stable, the same for the whole year, then you get that $800. Okay, you multiply by 52 weeks to get the whole year income, and then you divide by 12 to get a gross monthly income to use for loan calculation. That's how you do for hourly income. Okay, now what happened if your hour like change, right? You do part-time. Okay, let's say you instead of work 40 hours, you work 30 hours. Okay, week number 1, you work 30 hours. Week number 2, you work 20 hours. Week number 3, you work 40 hours. Week number 4, you work 50 hours. All right. So meaning that for each week, you multiply the hour with the hourly pay, and then you add them up. Okay, you add them up, and then that is for the monthly. Okay, that is for the monthly, and then you can use that as a gross monthly. But if every month is different, and then you have to multiply that by 12 and then divide by, you actually add every month together and then divide by 12. Okay, so that's how you calculate it. Okay, if you get a weekly income, meaning you get paycheck every single week, then you multiply that by 52 and you divide by 12 to get a gross monthly income to use for the DTI or income calculation. If you get a monthly income, then use it as is. Okay, it's a gross monthly income is equal all over. Let's say, however, if you get let's say you get an overtime, if you get a bonus, those are extra that you can add on. Right? If you can prove that that money is is stable for at least 1, 2, or 3 years so on, then they will take an average and they will say, okay, each month how much you get that the extra money, right? They can calculate for 24 months or 12 months, and then they divide that, to find per month what you get for overtime or bonus. Okay, and then they add that as a monthly income for you too, as a second monthly income beside your paycheck. Okay, half a year income, you multiply by 2, you divide by 12. Yearly income, right? Maybe somebody got payment at the first of the year, you work the whole year, then you take that money, take that total, you divide by 12 to get the gross monthly income. So that's how you verify and process the income side. What about credit report? Information included on the credit report, including what? Personal information, name, any past connection with any credit account, right? Any nickname that you use, right? Current and former addresses, current and former employers, okay? Birth date, social security number, and phone numbers, okay? Credit account, if you have any, open, active, evolving account, or you have usually they don't count any account that you close, okay? But a rule of thumb, if you a savvy investor, if it's a savvy person that want to grow your wealth, then if you open a credit card account, don't close it, keep it open, okay? But if you keep it open, you need to be responsible for your credit card. Use it a little bit, use it for buying ice cream, and then pay it off every month, okay? The reason that you don't close an account, because guess what? The credit history, depending on the length of the account, the longer the length, the better credit that you're gonna get, okay? Better credit score that you're gonna get, the better credit history that you're gonna get, right? So don't close your credit account, right? I did that when I was in the early 20s. I opened an account, get some, some incentive, then I close it. I use it for a purpose and then I close it, right? I closed it 5 or 10 of them, but because nobody tell me, nobody teach me. So if you open a card, be responsible and keep that card as long as you could, okay? And don't get yourself into a bankruptcy, okay? Meaning you overuse it, utilize the whole credit line. Try not to do that, okay? Be responsible with your financial, and that's how you grow your asset. That's how you grow your income and everything, and your net worth, okay? Keep in mind of that. Current and historical credit account, including type of account. Is it a mortgage? Is it an installment? Installment is any loan that you take, including auto loan, student loan, personal loan, right? Those are eventually divided into installments. Okay, any revolving account, revolving meaning credit card account, right? Thing that you pay as you use, and it's actually can accumulate the interest. It can actually grow and grow if you use more, and less if you pay off. Okay, credit account, the credit limit amount. So this is important right here. The credit limit or amount. Every credit card that you open, right? Begin with, you may get a $500 credit line. Yeah, over time they increase you to 1,000, and eventually you get 10,000 credit line. Imagine if you have 10 credit lines, okay, and each credit line have a $10,000. That means you have a total credit line of $100,000. Okay, when you have a credit line of $100,000, right, the credit score will get affected majority of the time when you have a utilization, or when you use it more than 25 to 30% or higher, then your credit score is gonna tank. It's gonna drop. Okay, so let's say $100,000 of credit line, you use $10,000 or $4,000. Okay, meaning you only use 4% or 10% of your total credit line. I guarantee you, if you keep paying back those numbers, your credit score is going to be at least 780 or above 800. If you only utilize 5-10% or less than 25%. Okay, so that's really important. Now take this into account. What happened that 10 account that you have with $10,000 per account, now those 10 account have a $20,000 credit line per account, and now you get $200,000. $200,000 credit line, and if you use, instead of you use 10,000, that's a 10%. Now, if you use 20,000, that's only 10%, right? 20,000 of $200,000 credit line is only 10%. And guess what? $20,000 is a big number. You can use that number, you can use that amount and go out and down for a house just fine. Okay, so that is how powerful the credit history, credit card, credit line is. Okay, the more credit line that you have, the better off that you're gonna be in the future. But be responsible. Don't overuse. Don't use like 50% utilization, 80% utilization. If you reach that amount, more likely you're gonna get a bankruptcy. Okay, so got to be careful on that. Use the credit line, use the credit history to your benefit, to grow your net worth, and using that to invest properties, to invest in real estate. Okay, this is off the limit. Okay, I just want to show you how to get a better future. But this is great, right? Even though that I'm telling you this, use what I tell you. Go out and tell your client, right? Teach them. That way, your client will do well in their in their financial situation, right? In their investment and stuff. And you can help them. They're gonna come back to you. They're gonna refer their friends and family to you, and you get more business, right? Good stuff. So the credit limit or amount is important. The account balance is also important, right? Try not to pay it off if you could. Sometimes if you get a free balance transfer, okay, not even free, it's like 3% charge. But that balance transfer, if you have, imagine, okay, let's say if you get that $200,000 credit line, and some of the creditor give you like $20,000 balance transfer at 0% for maybe 12 months or 18 months. Okay, now you go out and you buy a house. Okay, using whatever your money you have, right? And guess what? After you complete with your purchase transaction, you go in and you use those checks to deposit that. Maybe 4 creditor, each one of them give you 20,000, and then you get that money, right? You put in your bank, you get 80,000 right away. You can pay down your mortgage. Okay, you can use that money to renovate and then resell the property, make money, make the difference. Sometimes you can make 50,000 or 100 or even $200,000 by just utilizing the credit line that you have. So that is how powerful it is, right? Keep that in mind. Teach yourself, teach your client. Okay, account payment history, right? It's good that you have a variety of account types: mortgage, installment, revolving, right? But your account history that you pay it off is great and increase your credit score. Okay, don't be like your mom and dad. Have a 850-point credit score, print it out, frame it, put on the wall. Do nothing about it. Okay, if you have the great credit score, utilize it, right, to grow your net worth, to make more money. Don't frame it and put on the wall, because that doesn't make any sense, right? And guess what? Sometimes people that they buy one house, right, and they just try to pay it off. I get the credit score of 800, 850, pay it off. Guess what? When you pay off the property, your credit score from 800 drop to 500. Guess what? Because you don't owe anything. When you don't owe anything, nobody's gonna lend you anything. So your credit score from 800 may drop to 500, 600, right? So don't fall into that trap by just trying to pay it off, right? Guess what? When you pay it off, the bank has that money, right? You don't utilize that money to make money for you. The bank has all that money. And guess what? Your money trapped in the property forever. And guess what? If you pay it off, and then if you need some money for medical or whatever reason, now you go and you refi cash out, or you go and you do a HELOC. It's cost you more. Instead of have that money make money for you, right? And now you just give the money to the bank, right? So that's something that you need to be smart about it, right? Don't do like what your brother does. or the kind of phrase. Don't drunk like your brother. Okay. Anyway, let's continue. The date the account was open and closed, right? Try not to close, but open as long as you could. Okay. Name of the creditor. The credit card that I like most is American Express. Okay. The reason I like American Express is that it's increased your credit limit really high, right? Any other card you may get 1,000, 5,000, 10,000, but with American Express, when you do it good, when you use and you pay, right? It goes to up to $25,000. $25,000 credit line. Okay, easily, as long as you use and you pay, you use and you pay. With the American Express, you use every month, you pay off every month. Okay, and also the disadvantage of American Express is that when you run a credit report, okay, when you run a credit report with any other credit card, you may have a minimum payment of 2%. With American Express, you have 50% minimum payment. That's crazy. Okay, so meaning that if you have that, let's say if you have you just go out and you purchase like a couple of big items, over Christmas, and then now your balance is like $20,000, right? But you're gonna pay it off, but suddenly that you want to buy a house, right? Then the loan officer run your credit report, and it say that you got a loan or a credit balance of $20,000 in American Express, and the minimum payment is what, 5,000, 10,000. Then that's bad. Your credit, your DTI gonna shoot to the sky. Okay, so that is the bad thing about American Express. However, the next good thing about American Express is that first, you got the $25,000 credit line. Second, they give you the personal loan that doesn't run your credit, doesn't do a hot pool of your credit, and you can access that money instantly within several days, 3 to 5 business days. Okay, so I've used the credits, the American Express. Sometimes I when they offer me that, I can get like $35,000, $45,000 personal loan instantly, right? Now I can get that money, go and down payment for another property. Okay, that means that if I see an opportunity, I just get that money out, go do something, and pay it back, as quick as I could, right? And sometimes my strategy is that I get the American Express personal loan quickly, 45,000, go out and buy a house, and now I have many other credit line that give me $20,000, 0% for 12, 18 months. Guess what? I'm get 2 of them, and then I pay off the personal loan, right? And that's actually create some activities, and that's also mitigate some risk, okay? Because like when I do that, I'm actually putting myself in an investment strategy, right? But now I shift my money around by using somebody else, using the bank money. I'll pay some, maybe 2%, 3% fee each time I use it, but that's okay. I can buy a house, I can rent it out, I can make money. I can grow my network, I can have a portfolio of 5, 10 houses, right? That is how smart you should be when you do, play around with your credit line, okay? And if you're young, watch this video again, okay? Because that is how you're gonna do well in the future if you focusing on your credit history, your credit line, okay? Okay, a little bit off topic, but I'm so feel excited about this thing. Okay, let's move on. Sorry about that. Okay, continue with the credit report. Any collection item on the credit report, it's a bad thing. Any public record, including liens, foreclosure, bankruptcy, lawsuit, judgment, all of this gonna appear on your credit report. Okay, you get late payment, it's gonna stay on there for 2 years. Okay, even though they only count for 1 year. After that, they don't count that late payment no more, right? Your credit score may go up, okay, but it's gonna stay on the report for 2 years. You don't want anything bad showing on the report. Okay, if your foreclosure, I believe, is gonna stay there maybe 7 years, I think. Bankruptcy, foreclosure, I think it's 5 years. Bankruptcy, I think it's probably about 7 years. Okay, so try not to get yourself involved into those situations. Okay, A credit report might also include information on overdue child support provided by a state or local child support agency or verified by any local, state, or federal government agency. Okay, inquiries. Company that have access to your credit report. Okay, I want to buy a house right now. Okay, today my loan officer pour a hot pour on my credit report. That's one inquiry. Okay, I want to shop around. I go to a different loan officer. That loan officer run my credit report again. I got two inquiries. Okay. However, if you are eventually in the process of buying a house, it's okay to run 1 to 5 inquiries because eventually you only take out one loan. Okay, but don't go out and do like 10, 20 inquiries. It's bad. Okay. So during the process of buying a home, you may get your credit hot pull. Hot pull meaning it pull everything, okay, from your credit report, and then it's count only one. Okay. However, for each year, try to control how people, how creditors, how lender, how bank, how financial situation tap into your credit history. Try to control within 2 or less inquiry a year. That way, it's going to keep your credit score high. If you get more than 2 inquiries a year, right, then it look bad, on the credit report. You say, why this person get inquiry from these creditors, right? And the inquiry gonna be stay on the report for 12 months. So that's what happened, right? You can run the inquiry, every 12 months, and then when the first inquiry that you did is already 6 months old, right? You know that if you wait for a year for that inquiry to get it done, or 6 months you run the second inquiry, and then a month and a year and a half, you can do it again. So try to control the inquiry within twice a year. Then you're gonna be just fine. Okay, factor use the determination the credit score. Late payment affect the score. Inquiry affect the score. Credit utilization affect the score. Like I say, 25% or less, or 20% or less, or even 4% to 10% is the best. Okay, total credit lines, right? The bigger credit line, $200,000, $300,000 credit line, is great. Meaning that if you're using a big money, you're still under the credit utilization, right? So, and using the inquiry 2 a year, right? If you want to open the next credit card, wait for the first one expire after a year, you run it again, you open a new credit card. Okay, but like I say, any credit card that you open, you need to put some balance on it and then pay it off. Otherwise, they're gonna close that credit line from you if you don't use for a year, 2 years, or even 3 years. Okay. Revolving or installment. We talk about this. Is it a credit card or is it a personal loan or loans? Time. The longer the credit line, the better. Deficiency. Any wrong with your credit report, you need to work with the credit bureau or the creditor to clear it. Okay. Next thing is the qualifying ratio, which is defined as ability to repay or the capacity of how you're gonna able to repay. Factor when calculating expense to income ratio, the total housing expenses consists of all possible expenses associated with serving a house, including utility, property taxes, insurance, let me see. I think DSL, cable, but those are is minimal. But anything like regarding the insurance, property tax, mortgage, right? Any payment to the to energy saving like a solar or a heater or AC and things like that. Right? Those are housing expenses. Okay, to calculate the housing expense ratio, simply take the sum of all property expenses, divide that by the pre-tax account, pre-tax income. Okay, so meaning that here we're only talking about housing expenses. We haven't talked about the credit card or anything just yet, right? So This is what we call is a front end DTI. Front end DTI is for the housing expenses. Okay, anything related to the property, mortgage payment, PMI, tax, blah blah blah, escrow account, whatever. Add it up, divide by your income per year. Okay, before tax. If you make 150,000 a year, take all these expenses, divide by the monthly income, which is let's say 120,000 a year. That is 10,000 a month. Okay, if you get the expenses about 5,000 a month, and you get the 10,000 a month, that is 50% DTI of housing expenses or front end DTI, right? You want to keep that about 43% or lower. 50% is too high. Okay, but still, you may get a loan for that too. Okay, but spend like 4,300 for a $10,000 income a month. Okay, that is a DTI. Okay, that is the front end DTI. The back end DTI gonna including all the evolving installment credit card, child alimony, everything. Combine everything plus the housing expense, divide that by the total income. That is the back end ratio or back end DTI. Some lenders consider the front end only, some lenders consider the back end only, and some lenders consider both. Okay, so that is how I explain it to you. So we talk about loan to value, right? And we also know anything that loan to value 80% or above, you don't have to pay PMI. If it's loan to value about 81, 85%, then yes, you pay PMI. Or less than 80% loan to value, then you don't pay PMI. So we talked about this in the past. Okay, and here is calculating the debt to income ratio. Your debt to income ratio, which stands for DTI. Compare how much you owe each month. Each month, I'm talking about month. I don't talk about year. Okay, each month to how much you earn each month. Okay, especially it's the percentage of your gross monthly income before tax that goes toward the payment, rent, mortgage, credit card, or the debt. Okay, it's called debt to income ratio. Calculating the housing to income ratio, add up all your bills, monthly rent, HOA, child alimony, student auto, credit card, any debt, divide that by total gross income, which is your income before tax. Calculating the total debt ratio by adding all these housing expenses with all the debt liabilities, divide that by the total income per month. Okay, so we're talking about the ability to repay, right? The SAFE Act, right? We have the lender need to make sure the borrower have enough money to pay back or the ability to repay. So the factor take into consideration when you're reviewing an applicant ATR, ability to repay, including the employment and the DTI. Make sure that person is still employed, make sure that person have a good income, and make sure that income to expense ratio is 43% or lower, which is the DTI. Okay. Method of verifying the income assets, including the income is R, W-2, 1099, tax return, business income, pay stubs. Okay. Assets, including bank statements. Okay. Verify the income using the bank statement. Okay, meaning that there's maybe a business owner that depositing all the money into the bank. That's the only way that you can verify. Okay, determining a borrower ability to repay using the calculated DTI, and 43% is the one that we're looking for. 43% DTI. That is guaranteed a good loan. Right? Anything between 43 and 50, the borrower may get a loan, but may have some cost to it or may have a higher interest rate. Okay. Safe harbor provision and scenario. Follow the GSE, which is the government. Oh man, I forgot the acronym for this one. Something entity. Okay, which are the two, Fannie Mae and Freddie Mac. As long as it meets the guideline, it is a safe harbor provision. Okay, tangible net benefit. What is it? Net tangible benefit referred to as the benefit that the borrower experiences with a proposed refinance loan. Okay, so let's say if you able to get the borrower able to get a loan, right? And then at the higher rate, then down the road, if the rate drop, then the borrower can, refinance again. The borrower may be now paying 4,500 a month with a better interest rate for 12 months from now. That borrower may pay 3,800 a month. So that's the net, the tangible net benefit by the shifting in the market. Okay, occupancy type, including what? Primary resident, rental property resident, second home, and vacation home. We talked about this. So if the borrower want to buy this home as a primary, you get a better rate than the primary. Or if you get a rental investment home, maybe you might pay a little bit more on the fees as well as the rate. Request for verification of deposit. Okay. The verification of deposit, let me see. That is, okay, let me read the whole thing. So there is a form called 1006, okay, or form 1006S. The information must be requested directly from the depository institution. The complete signed date document must be sent directly from the depository institution. Okay, so meaning that if you require the deposit, the VOD, which is verification of deposit, then you can ask the bank to to certify all these deposits that that you make through the bank account, and sometimes lender that require that VOD to able to kind of review the loan, which including copy of the bank statement that has clearly identified the financial institution, identify the borrower as an account holder, include at least the last 4 digits of the account number, including the number period covered by the statement, all deposit and withdrawal transactions. Majority of the time, if we provide the bank statement, that's a VOD, that should be enough. It doesn't need to be certified or signed by the bank personnel, right? But some of them, if you don't have maybe the bank statement is not coming out yet, right? And you do need the VOD for these charges or these deposit that you just put in. Then yes, the borrower need to go to the bank and ask for the VOD. Okay, so all this kind of stuff. Appraisal. 3 appraisal approaches. Okay, market approach, income approach, and the cost approach. Okay, so the appraiser sent out by the lender go out and take appraise the property, and there are 3 separate way of appraise the home. Using the market approach, this approach is a common method where the appraiser value the property based on the recent sale in the area. Income approach is that this property, how much can it make? If it's for rental, how much it's gonna make, right? Including income capitalization approach. This estimates the value of a property based on the income it generates, right? We can run using a tool and say, okay, address 1, 2, 3, First Street, how much can it make a month if we put it on the rent market? Okay, that's something that can be evaluated too. Cost approach usually how much it costs to rebuild this home from ground up. Then that's how they calculate the cost of the appraised value for the property. So appraisal using comparable information to establish the value is a good approach. With some, compare with some, property with a similar characteristic like location, square footage, bedroom, bathroom, age, condition, lot size, or sales date. Okay, if it sell like 12 months ago, it may be different than if you want to sell it now, right? It's now maybe more expensive, or when a downturn market, if you sell 12 months ago, it may be higher than if you sell now, right? So the time is also crucial as well. Sometimes that you pick like 3 months or even 1 month, but if you cannot find any calm, now I'm talking about calm, right? Calm is comparable property. And if you cannot find any calm, maybe you have to spread it out 6 months or even 12 months. Appraisal requirement with a high risk mortgage, including FHA, need appraisal, and is it a full appraisal? FHA and VA loan always require appraisal. Ordering appraisal, only the lender is allowed to order an appraisal, and as a borrower, as a loan officer, as a realtor, you don't interfere with the appraiser when he or she is doing the work. Okay. Here we say that only the lender can order appraisal. However, as an owner, you can also request an appraisal too, but that is just mainly for your own use. You cannot give that appraisal report to the lender to qualify for your loan. Okay. Okay, requirement timeline to inform the applicant of the right to receive an appraisal promptly upon completion or no later than 3 business days before closing or before consummation. The borrower have the right to request the appraisal report. Okay, but usually when we request as MLO, we put in a request to run, to have an appraisal coming out. When we get that report, we see it, we send it to the borrower. This is the report that we can send to the borrower. We cannot send the credit report, but we can send the appraisal report because the borrower paid for this report to evaluate the price of the home. Okay, facts on the appraisal, including when evaluating all comparable home must have the same characteristic, not just the price accordingly. Okay, sometimes an appraiser cannot accurately appraise the house in a closed community where there is no recent sales. For example, it's easy, right? If you look at an area in a zip code, or in the proximity of the property, right? However, if there's a little community that may have like 50 homes, gated community, right? And it's in that zip code, surrounding by many different other kind of homes. This community is a newer built, I should say. Okay, then you cannot pick the home in this community or pick the home that outside of this community and compare with the home in that community. It's almost impossible. Okay, the value, don't equate. So what happened is that within that community, okay, if there was a home that sold that last 3 months, 6 months, 12 months, or even 2 years, right? If that gap is longer, the appraiser is going to have a hard time come up with the true value. Okay, so when the appraiser cannot come up with a true value, then he's going to pick the one that sold like 12 months ago, which is like $100,000 less. And guess what? When that $100,000 less, then meaning the bank going to get $100,000 less in the loan amount. Then the borrower had to come in with the $100,000 difference. But that value is not correct because there's just no comp to compare with. Okay, so that scenario, that situation I have seen so many times. Okay, no one can influence or interfere with the appraisal work. Different appraiser might get different estimates, sometimes in the tens of thousands of dollars. Sometimes appraisal can be waived if the house was recently sold within a year or data is not available to the under desk appraisal. If the data is available under desk appraisal. Title report. Okay, let me see. I'm sorry. We have quite a few here, huh? I'm seriously overrun today. Okay. Let me see here. Title report. A title report is a document that outlines legal status of a property related to the information on its ownership. Several key components must be included in the title report, including the information of the county, the zoning law, the property value, the current tax information is on the title report. Okay. The title report is running by a title company to give you everything about the home and the title, thing that can affect the property, can affect the title, someone that take on the title. Okay. Obtaining the title report, you can hire a title company to provide a title report of the property. Timing of the title report and commitment, right? The property title search process usually take about 10 to 14 days. So that needs to be done. If you're listing this property, you need to run that really at the early days. Okay. Then you can also get like a preliminary title report first. Preliminary title report is just like something that can run quickly. And then you have to dig deep. The title company have to dig deep down to find more information related to the property. So there's no hidden lien, there's no judgment, right? There's no will, maybe. Okay, what to look on the title report? The public record errors, lien on the property, encumbrances or any money that falsified documents, right? Estate claims, property dispute. You may dispute with your neighbor, with the government, or whatever. Falsify identity. Hey, you're not the one that owns this house, right? So those are the things that you need to watch out for. Violated in building code. You build something with no permit. Okay, those are the things. Because if you assume this property, then you are liable to fix those things. What is a title insurance? Right? We're talking about this. Title insurance protect the owner or lender against any problem with the title. Right? So we have two types of insurance, right? An owner insurance and the lender insurance. We'll talk about this. What are the common property title problems, including liens, easement, encroachment, covenant and condition of restriction, historic oversight, and requirements? So these are some of the common issues. So we talk about the flood law by FEMA, right? The flood insurance. So if the property end up in the flood zone, yes, you do need a flood insurance. Okay, we call this. So like I said, anything that in the designated zone of flood, maintained by the map, by updated by FEMA, right? And that flood insurance rate map identified by the special flood hazard area. We talk about this, in the law section. Limit on the flood insurance. So now everybody need to be able to buy flood insurance. So and the price is lower, right? We talk about this. Private flood insurance company as well. Forced place insurance, there's some requirement to actually have to pay for the insurance if you're in the FEMA identified flood zone. And we also talk about PMI. The purpose of the PMI, 80% or less. You don't need PMI. 80% or more loan to value, yes, you do need PMI. Okay, benefit of the PMI can help you buy a home sooner, can open up payment and housing option. You can take advantage of low mortgage rate. PMI isn't forever, just a short period of time. Your lender will take care of the details, right? The servicer, and some lender may buy out your PMI too, right? I talk about this in the competitive market. Some lender, they offer, I'll pay for your PMI, even if you only down 15%. Requirement guideline to ending the PMI, we talk about this, right? The HPA, PMI is required. If it's like 80%, you call it in. Say, hey, my loan to value ratio is now 80%. Please drop the PMI. I don't want to pay that no more. If it's automatically go to 22%, lender will have to do it for you automatically. Okay, hazard and home insurance, right? Including fire, wind, hail, explosion, theft, vandalism. So make sure that when you buy the home insurance, you have to including the theft and vandalism in there too, because if you're in an area that maybe is have things like this happen, then make sure you have the insurance cover for it. Power surges, civil unrest or not, falling object, from the sky, you can buy insurance for that too. Okay, water damage, burst pipe, back in 2022, I believe, in Texas, there are like tons of homes get burst by pipe when there's like the weather, the temperature drops so low, the water in the pipe, and it's called a burst, and then got flood everywhere. Okay, forced place insurance known as a creditor place, lender place, or collateral protection insurance. You have to buy insurance. Okay, otherwise the lender won't give you the loan. Government mortgage insurance, an FHA loan requires that you pay two types of mortgage insurance: the MIPS, an upfront MIP, and an annual MIP, which is paid monthly. In 2022, the upfront MIP is equal to 1.75% of the total loan. Okay. Title and title insurance. I think we cover a lot of this. What does the title insurance cover? Improper execution, or the mistake, undisclosure, unpaid judgment, lien, blah, blah, blah. Right? We talked about a lot of this in the past. And also lender title insurance, right? Just to protect the lender. Title and title insert again, continue. The priority in multiple mortgage scenario, a lender policy ensure that the lender's security interest in the property has a priority over the claim other may have in your property. So meaning that, even if the seller paid the title insurance for you, the lender always take precedent, right? Because they put in a bigger interest. They give you a large amount of money. So they have to take their money back first. Title insurance also mentioned about the easement, identify easement on the property. There may be a storm drain. There may be an area where they're servicing the electrical pole, right? Or a bridge, right? Whatever. So those are called easement. Encumbrances is a claim against a property by a party that is not the owner. You owe somebody money, either hard money or a lien or whatever. Okay, conveyance. A deed of conveyance is a legal document that indicates the transfer of a property title from a lender to borrower. So let's say if the borrower borrowed this, bought this home like 20 years ago, he or she is really good at paying, and now she pay it off in 15 years. So when he or she pay off the property, pay off the mortgage, and then the lender is going to send a deed of reconveyance. Okay, that is a letter saying, hey, congratulations, you officially own this property and you owe no mortgage to us no more. So this is a deed of conveyance. Did you keep it? This is your record. It's a good thing, when you have the deed of reconveyance, right? You pay off, but sometimes pay off is not a good thing. Okay, you rather use the money wisely instead of just keep paying in there and then your money gets stuck with that property. Instead of you can double, triple, that money, if you invest elsewhere. Okay, settlement and closing agent. Let me see if this is the last one. Yes, it is. Borrower, seller ability to review the HUD, closing disclosure statement. Okay, make sure you're double checking. Make sure there's no issue, there's no mistake on the CD. Okay, comparing the APR, right? All the fees, including the rate, need to equal to the APR. Okay, make sure there's no hidden fee that doesn't meet the tolerance. For example, we're talking about tolerance, right? And then things like that you need to review, especially the loan officer need to review it first, before send it out to the borrower, asking a lot of questions that you don't understand anything. Even you can hire an attorney to help you with looking at the CD as well. Eligible signature on the security instrument must be 18 years of age to sign anything, even to buy a house. Must be able to, in the capacity to sign. You are not sick, you are fully aware, your health is in a good condition, then you can sign. Borrower on the loan are the one that actually sign. Co-owner also need to sign certain document, meaning that co-owner may be not on the loan, maybe on the title, everybody on the title, but maybe one or two person on the loan. So the one on the loan is going to sign more than the one not on the loan, but still have to sign some document, for both the lender as well as the title. Okay, use a power attorney. Okay, the power attorney can be used. Power attorney meaning that, hey, I cannot be there, right? I want somebody else to represent me to sign these documents. This is the power attorney. Okay, thing like this can happen is that if husband and wife or wife is in another country, cannot be back to sign it, but want to dedicate this job to somebody else, mom, dad, or even a husband to represent her to sign it for her. Okay, so it's called a power attorney. Power attorney is giving somebody the ability to represent that person. Fee charges are listed on the HUD or CD. Okay, any fee that listed on the CD need to be correct. Title insurance fee, prepay fee including the appraisal, inspection, credit report, repair, estimate quote. So we saw this during the demo yesterday, right? Type of escrow expenses including recording fee, real estate fee, loan fee, third-party payments, and seller profit. Loan origination fee is a loan originate amount charged as percentage of the loan, usually between 0.5 and 1% of the loan amount, plus any mortgage point associated with your interest rate. Okay, so loan origination fee meaning that, hey, usually loan origination fee is the commission, our commission. Okay, that's how much we get paid. Okay, at least to the forefront, there's some credit in the back that the lender give that you can either keep it or you can give it to the borrower too. Okay, and that actually added up as a loan origination fee. Some can be disclosed, some can be hidden. Okay, thank you. I'm sorry I overrun a little bit, because I give a lot of good examples today. Anybody have any question for me? Anything? Nothing? Good stuff, huh? Okay, if there's nothing, then I'll see you tomorrow, the last day before weekend. Okay? Have a good day, everyone.
Yeah, thank you.
Yeah, thank you.
Bye-bye.
Good night.